Keating Capital CEO Timothy Keating joins me now live from the NASDAQ market site in Times Square. Mr. Keating, welcome to Bottom Line and congratulations.
Well, thank you very much. It's a great pleasure to be here today.
Sir, you called today's listing the final step in a 3-year process. What were the other steps?
Well, we began our fund back in 2008, so that was the formation. And then we went through a rather unusual process of registering to go public, raising capital from individual stockholders, and then culminating in our public listing on NASDAQ today, which was about 6 months after we completed our public capital raise.
Mr. Keating, why invest exclusively in pre-IPO companies? Aren't you taking a gamble in this current climate of global macroeconomic and political uncertainty?
I think there's a big difference between investing in an IPO and a pre-IPO. And so what we try to do is get in early in private companies, and typically there's a big valuation differential. So public companies are typically valued about twice as high as private company with similar financial attributes. So the whole goal of our fund is to buy privately, sell publicly, and capture the difference. So if we do our jobs well, we've invested early in these private companies, and by the time they go public, there's been significant appreciation in the price.
Sir, you're looking to create a portfolio of approximately 20 companies. Each portfolio company investment typically held for 3 years. Why the short-term time horizon, and what's the outlook for investors who get out before 36 months?
Well, we certainly don't advise anyone to get out before we complete a full investment cycle. But the reason why we have a relatively short investment cycle is most of our companies are expected to go public within 18 months from the time of our investment. We are then subject to a 6-month underwriter's lockup, which brings us about to 2 years. And then in that final year, we are generally harvesting our investment. To put that 3 years in perspective, the average mutual fund today holds a stock for less than a year. So we're about 3 times longer than the average stock mutual fund.
Mr. Keating, you like technology, internet and software, and clean tech. Why and who do you like?
Well, we like these companies because that's really where the growth is in America. And there's really, despite all the malaise and all the negative things that you hear every day, there's just some amazing things going on in Silicon Valley every day. So these are the kind of companies in these sectors that are the candidates to go public today. So there's been obviously a lot of publicity, both positive and negative, about clean technology, but cloud computing, technology generally, there's really a lot of very exciting developments. So we're trying to get in early in these private companies before they go public.
Mr. Keating, we have about a minute left. We're going to experience a final blast of IPOs hitting the market just this week. 11 new stocks are scheduled to price before the holidays. What do you think's behind this mini resurgence?
Well, this is the backlog of something that's been building over time, and up until August of this year, we were having a relatively strong IPO market. Today, there are about 200 private companies in registration to go public. We will probably end up with about 125 IPOs this year in 2011, to put that in perspective. So there's a great demand from institutional investors. There's a lot of companies seeking access to the public capital markets. And a lot of these private companies are doing a final round of private financing just before they go public. And so we're trying to help provide that capital that's getting these companies over the goal line.
Timothy Keating, Keating Capital CEO, joining us live from the NASDAQ market site. Mr. Keating, thanks so much for your time today. And again, congratulations.
Thank you so much.